thousands of people are losing their jobs in the EV market. The electric vehicle industry, once booming with growth and innovation, is now facing a massive slowdown. Big companies like Tesla, Rivian, Ford, GM, Fisker, and NIO are cutting costs by laying off workers. What's causing this sudden change? Well, it seems like the EV market has become a victim of its success. With so many manufacturers jumping on the electric bandwagon, competition has gotten fierce. This has led to a price war, with companies slashing prices left and right to stay in the game. But these deep discounts come at a cost, and that cost is turning into financial losses for many players in the field. Now, when companies start seeing more red than green on their balance sheets, they begin to tighten their belts. And unfortunately, one of the first notches they pull in is the workforce. Take Tesla, for example. The EV giant recently announced a 10% workforce reduction, which translates to about 14,000 employees getting the pink slip. That's a big number, and it's not just a random cut. It's a calculated move to stem the company's financial struggles. And it's not just any region that's affected. The layoffs are happening across the board, with significant job cuts in Texas, California, Nevada, and Buffalo. Plus, it's not just the assembly line workers who are being shown the door. The software and service sectors are also feeling the squeeze, and there's been a noticeable departure of key executives from the company. But why is this happening, especially to a company like Tesla? A big part of the problem is the drop in sales, particularly in China, where Tesla sales have plummeted by 43%. That's a huge market, and losing ground there can dent any company's armor. Rivian, which once seemed unstoppable, is struggling with sales not meeting expectations and costs soaring. They've had to make some tough calls. Just this February, Rivian said goodbye to 10% of its workforce, and now they're cutting another 1%. It's a tough pill to swallow for a company that's been all about innovation and pushing the EV market forward. But the reality is, they're burning through cash faster than they're making it. And in the cutthroat world of EVs, that's a dangerous place to be. Rivian's been trying to turn things around. They're not just sitting back and hoping for the best. They've been getting their hands dirty, quite literally, by building more parts in-house. They're also at the negotiating table, trying to get better deals from suppliers. But even with all these efforts, the financial struggles continue. Now, they're putting their chips on the R2 SUV, a new model that's easier on the wallet. The goal? To get back on track financially by 2026. It shows that Rivian still has some fight left in them. They're not just going to roll over and let the market steamroll them. But here's the thing, layoffs are never just about numbers. They're about people. Families are affected, dreams are put on hold, and it's a reminder that the EV industry isn't just a race to make the coolest cars. It's a business. And sometimes that business can be brutal. Fisker's journey in the EV market has been like a roller coaster ride, full of ups and downs. Recently, the company has been going through a rough patch. Despite the launch of their new Ocean SUV, Fisker is grappling with some serious financial challenges. The company's stock has taken a nosedive, and it has had to let go of more employees. The layoffs aren't just a few here and there. They're a part of a larger plan to restructure the company. Fisker is on the lookout for potential buyers or investors to bring in some much-needed cash. But it's not just about finding new funding, it's about survival. What strategies can Fisker adopt to improve financial stability and product quality quickly? They've reported a substantial loss per share, and their gross margin has been negative. Fisker is burning through cash at an alarming rate. To add to their troubles, they've had to pause production of the Ocean SUV due to sales not meeting expectations and a series of quality issues. In an effort to improve its situation, Fisker has shifted from a direct-to-consumer sales strategy to a dealer partner model. It has also been in talks with a large automaker for a potential investment or partnership, but those talks fell through, leaving Fisker in an even more precarious position. The situation has become so dire that Fisker is considering seeking bankruptcy protection if it can't meet its debt obligations. It has already missed an interest payment, and its cash reserves are dwindling. The company has been delisted from the New York Stock Exchange because its share price fell to abnormally low levels. With all these financial struggles, experts are questioning whether Fisker can keep its doors open. The company has warned of ongoing concern risks as there's substantial doubt about its ability to continue operating in the near future. It's a tough time for Fisker and its employees. The workforce has been reduced by 15%, and there may be more cuts to come if the company can't secure additional funding. The layoffs have affected various departments, and the company is trying to streamline its operations to preserve whatever cash they have left. Despite the challenges, Fisker is still fighting to stay afloat. They've cut the prices of their Ocean SUV models to try and boost sales. They've dropped the price of their basic Ocean Sport SUV by a lot, from almost $39,000 down to about $25,000. It's a tough call. But in a market as competitive as this, sometimes tough calls are what it takes to stay in the race. But NIO isn't alone in this high-stakes game. The global EV market is going through a bit of a rough patch. Sales are up, sure, but so are operational costs, and that's putting the squeeze on profit margins. Manufacturers everywhere are feeling the pinch, and they're all looking for ways to cut costs without stalling out. One of the main ways companies are trying to save some cash is by reducing their workforce. This move is affecting thousands of employees worldwide. It's not just about the bottom line, it's about survival. In an industry that's all about the future, these companies have to make some very present-day decisions. Are EV manufacturers experiencing significant layoffs due to market challenges? EV manufacturers are in the midst of a major shakeup as they're pulling out all the stops to keep their businesses running smoothly. Production is being dialed back, and the release of new models is on pause as companies try to figure out their next move. It's not just about cutting back though, they're also getting creative, looking into launching more affordable models to draw in customers and get their finances back on track. The success of these strategies is more than just a make-or-break moment for individual companies. It's about shaping the future of the entire EV industry. We're talking about a radical transformation here, with every decision and adjustment potentially rewriting the roadmap for electric vehicles. But this isn't just an EV story, it's a glimpse into the future of the automotive industry as a whole. The shift towards electric vehicles isn't just a trend, it's a response to growing environmental concerns and increasing regulatory pressures. This transition, however, is proving to be anything but smooth sailing. It's complex, it's costly, and it's filled with challenges that need to be tackled head-on. Are we witnessing a temporary setback, or is this indicative of deeper issues within the industry? Share your thoughts in the comments below. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated.